Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark discusses how things are going on the major equity markets. Canadian real estate consultant Ross Kay explains Vancouver home prices have already dropped over 25%. Corbett Report editor James Corbett tells us what's happening in Japan and China. And Mackey researches Payton Nyquvest's weekly digest on Canadian junior markets. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
The equity markets, so many people are saying, oh, we're back into the bulls, yet others are saying this is the time to grab your money and run away. What is happening out there?
Well, it's, we've gone into, as you say, this phase where it's not as clear as people would like. It's very muddy right now. Now, what I like to look at are the seasonal perspectives on this, where you would expect normally that you would get a summer rally, and in particular in a year where you are in the second term of a presidential term. So you would typically have a May-June bottom, which we did. Then you had that quick knee-jerk movement down for 2 days around the Brexit vote. But from there, you had the dramatic move to the upside and a small pullback after that, followed by a move to higher high but on lower momentum. And that is actually the classic that we would see in the second term of a presidential cycle. So that first momentum high creates very big overbought readings. The second one, typically, as we're seeing now, things such as the relative strength, the MACD, that's a moving average convergence divergence and analysis, that is producing a lower high. So we can see that this market's tired. We also see that volatility has just dropped like a stone. The volatility index, which typically would be up in the 15 to 20 range. Now we're down into the 10 to 12 area, very, very low. And when we look at what's called the VIX, or the Bollinger, starting again. When we look at the width of the Bollinger Band, which measures the volatility, we find that it's at the lowest levels that we've seen in 20 years. Now, it's been close to this numerous times in the past, and most frequently during the months of July and August. So it's typical for the summer to be one of those quiet phases where you get a day or two of upside action, a day or two of downside, but you don't have a concerted move because of the anxiety, especially as you're moving towards the third quarter, which typically is where you tend to see weakness in the markets. So looking at where we are right now, the second half of August is probably going to set up for a bit of a rolling period. From what I see, the norm on the presidential here would be about a 4% break. That'd be sort of the minimum that I would look for. If it starts to have trouble at that 4% support area, it might go to double that. So overall, about an 8 to 10% drop off the high. So that's from a seasonal perspective. If I take a look at the breadth of the market, I see that if you take the S&P 500, which is a capitalization-weighted index, that being that the biggest stocks have the biggest percentage influence in the index, and if we compare that to what's called the equal-weighted index, where each stock is given a similar rating, that ratio shows that it is doing poorly in that it's not making new highs, and you really want to see leadership across the board. You don't want to have it in a minute group of stocks within the index. So we're seeing some divergences there. The other thing we're seeing is that while the Dow industrial index has gone to new highs. Neither the transports nor the utilities are confirming that. And that Dow theory, which has a great track record going back decades, when you see this type of divergence and then start to put in some lower lows, that has been indicative of a market that has a pretty good break as well. And for the last 20 or 30 years, those breaks have been a minimum of 8%, and the average one is down at about 16%. So going into the fall, that would be another reason to be looking for a corrective phase, not a bear market, but enough to provide some better buying opportunities.
Has there been much of a difference between the performance of the Canadian senior exchanges and the American ones?
Well, the Canadian were doing exceptionally well in the first part of the year, especially because of what we saw in the materials, that being the energy and the metals and mining sector. But in the last 6 weeks or so, the Canadian has started to subside a little bit. So if you look at the two based upon a common currency, if you factor out the action of the Canadian dollar movement, you see that the Canadian market has been underperforming. And if anything, it's because these precious metals, which have been the leading sector in the market, have been under a little, well, I shouldn't say a little bit of pressure, but we've definitely had a lid starting to appear in these stocks in the last few weeks. And most people look at seasonality as far as the mining sector and precious metals, and they want to look for a mid-July, late July start to a rising trend into September, October. But our research shows that if that rally gets started early as it did this year, it tends to peter out much faster. And by the time you get into early August, where we have been, the rally tends to then run out of steam and have a decent correction.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, Investment Advisor at CIBC Wood Gundy, Vancouver. Coming up, Canadian real estate consultant Ross Kay on This Week in Money.
Always consult your investment professional before making any investment decision.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is real estate consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to This Week in Money, Ross.
Thanks a lot, Jim.
The Vancouver Real Estate Association just released figures saying they expect a 10% price correction by the end of the year. What's the real state of real estate in Vancouver?
Well, the real state of real estate in Vancouver is just exactly as how we've outlined in your show in the past. Currently, your prices are off 26.4% off peak pricing. And what the Real Estate Board of Greater Vancouver just released, in my personal opinion, there should be a class action lawsuit lobbied against that association for giving false information for so long. The truth of the matter is their claim that the prices will drop 10% by the end of the year. Does that mean on December the 30th of 2016, the average selling price reported in the Real Estate Board of Greater Vancouver will be 10% lower than the average selling price reported December the 30th, 2015? Or are they saying that from July the 30th, 2016 till December the 30th, 2016, those prices are going to drop 10%. What exactly did they just tell the public? Once again, the Real Estate Board of Greater Vancouver, through their own incompetence and ignorance on how a housing market functions, have just given more bad advice on top of the years of bad advice they've been giving to consumers. What they're trying to do is make it sound like, oh, it's only a 10% drop, but don't worry, your housing prices went up 30% in the last year. In all probability, what they're really said is the benchmark price, probably the composite benchmark, will drop 10% by the end of the year. What that means is, since the benchmark is a fabricated number, a number with a methodology that has been rejected universally around the globe, but is still upheld to Vancouver residents and everyone in British Columbia, by the way, as being a factual representation. Actually, they use the word a better measure of price change. That number always delays what's really going on between 2 and 6 months. If anyone questions my authority on this comment, I encourage them to go to the Korea website, the MLS HPI index, and look at the Toronto aggregate and the Calgary aggregate, because you will see in those two cities where the benchmark is exactly the same methodology that supposedly British Columbia is using, specifically Vancouver, those aggregate sales prices, benchmark prices, align with the average selling price 100%. There is a standard 2 to 6 month delay between when it aligns, but it always has aligned since the day it started with the average selling price. It's just a little bit a difference in the number of months until that matches up, and that is a result of how long it takes the sales volume that's going on to get registered in the average selling price. In British Columbia, in BC, if what the real estate board is saying is that prices are going to be down 10% from where they are now at the end of the year, this is what your reader or your listeners need to understand. There were around 25,000 sales in the first 7 months, in the first 6 months of 2016 in Vancouver. Your market died in July, exactly as we had forecasted it, because foreign buyers left the market starting in June and had totally abandoned your market by July. Those statistics, as I've said on your show, will be reported by the government in the September and October closing data where they're searching for foreign buyers, where at that time they probably will find next to none because they all quit buying in June and July. In order for the average selling price to drop 10% in the second half of this year, that means the homes sold between August and December the 30th will have actually had to have been sold 30% less than what the homes sold in the first part of the year. Now remember, I've already told you housing prices have corrected 26.4%. I am already on the record saying that. All they have done is they have taken what I have said. They know they're caught. I've been in banter with the president of the Real Estate Board of Greater Vancouver where he's challenged my numbers. Well, I guess he just backed out of all of his challenges because what he said I said was not true. Yet the Real Estate Board apparently just said what I have been saying for months on end is true. The consumer needs to know you cannot trust a real estate agent or the Real Estate Board of Greater Vancouver. They don't understand their own housing market. Doesn't mean that they're not nice people. It doesn't mean that that all of them are doing this deceptively. It just means that they have no training in how housing markets function. There are 115,000 real estate agents across Canada. Actually, we'll use the word realtor because that's a trademark brand. Those 115,000 realtors have never, ever taken a single course in how a housing market functions. They could not even explain to you how the average selling price goes up and down. As far as I'm concerned, what they just said was 100% BS, and I know right now that it's costing Vancouver homeowners tens or hundreds of thousands of dollars because of the bad advice they've been given.
Compared to other real estate bubbles, how does Vancouver's price drop compare?
There has never been a price drop of 26% in a 6-month period in the history of Canadian real estate. There has never been a price drop of 26% in the same window in the United States of America. And you've got to remember, the United States of America is a country where people walk away from their homes. In the United States, every month that you own a home, there's a tax savings. You get to deduct the interest on your mortgage against your income. In Canada, you don't get that benefit. You have to own your house, and then when you die and someone else gets the inheritance, that's when the tax saving takes place. The tax saving only takes place when you sell, and if it's gone up in value, you don't pay any capital gains. In the United States, it's like you're a landlord. You see, being a landlord in Canada is a fantastic investment strategy because of the tax savings. If your home drops in value $100,000, worst case scenario, you're going to be able to write that $100,000 loss as a capital loss. So if you have any other investments or your accountant is following the rules of the law, there are other ways to make that $100,000 be reduced to about 40, maybe even 25. That's what an American homeowner has the advantage of. So he can walk away from his home. The great house price correction in the United States, the reason why it happened is because they were getting tax savings all the years they owned the properties. There was no benefit for them to hold on to the property, suffer through 20 years of waiting for the house price to recover, suffer through years and years and years of paying high mortgages way more in excess of what the home is now worth. But in Canada, no. Canadians will suffer through, as we always have, because we won't give up our home. There is no advantage other than in Alberta, where there's a non-recourse mortgage clause. In the rest of Canada, not only can you not afford to walk away from your home, if you do walk away, you're going to have the bank, who's pretended they've been your friend for the last 10 years, offering you these outstanding mortgages at these low interest rates, knocking on your door with an eviction notice, telling you that they are also going to sue you for any losses that bank incurs. Not only that, CMHC and the Government of Canada is going to be a willing participant in those lawsuits. That's why Canadians we have such a low foreclosure rate. There is no benefit to a Canadian to walking away. So, the 26.4% house price correction that my firm has already calculated is ongoing in Vancouver today, and we have the data to back it up. That is the single largest collapse of a housing market in North American history. And your residents, your listeners, they don't even know what happened.
You're listening to This Week in Money. I'm Jim Goddard. We're chatting with real estate consultant Ross Kay. Is Vancouver the canary in the coal mine for the Canadian real estate market?
Again, people can go back and listen to your shows where you interviewed me months ago. Every single housing bubble breaks in a different way, and the magnitude of the pop, how big the pop's going to be, is wholly dependent on how a housing market is structured as you go into the correction. As I've said on your show before, the Canadian housing market has been set up in such a manner that when this correction rolls out in Vancouver, it is going to be so rapid nationally, it's going to catch every economist in this country off guard. If you go to any newspaper today and you search and find one economist anywhere who told you back in March, April, and then in May, which is on your recordings on YouTube, that the Vancouver housing market was going negative in August, you can't find it. As a matter of fact, my firm received extreme condemnation because we made that call. The difference is, we didn't just make the call, it's just simply how the real estate market functions. We are not geniuses. It's not my fault these economists don't know how a housing market functions. They want to believe the real estate board say, there's no listing inventory, so that's low supply. Listing inventory is a leading indicator of future sales activity. So all of these low listings that the boards have been talking about, driving the prices up, there's more demand than supply, is a 100% lie. Demand is dependent upon those homes selling. If Joe doesn't sell his house, he can't go out and buy another house. So that means there's no demand going forward. The Canadian housing market, the Canadian economy, I don't even know what I have said on your show since December, when you removed the extra activity in the real estate market from the Canadian GDP, Canada has been in a recession since last December. We would have not had a single month or quarter of growth since December of last year. Overnight, Vancouver's housing market is going to be off around 20% in volume, and then on dollar volume on top of that. That's just in Vancouver. Now we have Fraser Valley. All of those people in Victoria, Vancouver Island, Kelowna, who are smiling because of those record house prices the real estate boards announced last month. They announced a record when Vancouver and Fraser Valley announced that sales had declined. Well, that's how a housing market functions, folks. The peripheral markets are the last ones to see the big price gains. They're also going to be the ones who very quickly see all of that vapor equity disappear. This is simply how housing markets function. There is a bit of a theory to the comment, real estate is local. Yes, that is true. If my neighbor has a garage and he brings in monster trucks, it's going to be hard for me to sell my house. But the bigger concern is real estate in Canada is provincial. What happens in Vancouver is going to happen in Kelowna, it's going to happen in Victoria, it's going to happen across the province, and as we said in your last show, you guys are going to an election in big, big trouble.
Do you think Christy Clark, the Premier of BC, will be blamed for the downturn in real estate prices because she put that 15% foreign buyer tax on Greater Vancouver homes?
She'll get blamed for it, yes. She's going to be blamed for it. I'm expecting she'll be blamed for it as early as September. That's how quick it's going to come on her. Now, the real estate board is going to do everything in its power to shift the blame from realtors onto the government. If you look at what the real estate board immediately reported the day right after this tax was implemented, and you look at all of the newspapers in British Columbia, you have seen a concerted attack by the real estate board to turn the arrows away from their incompetency, like when they lost the right to self-regulate, shadow flipping, failure to complete FINTRAC forms. Just outrageous. What did I see in the paper the other day? Some gentleman had lost his wife, and the realtors, they're knocking on the door. These are 1950s real estate techniques. The real estate agents are going to do everything in their power to point those arrows now at your government. And the government was foolish enough to bring that policy in, listening to everybody else, instead of simply picking up the phone, calling me and saying, hey, how do you guys know foreign buyers left our market? Show us the data. I would have pointed them right to the government's own data that would have showed them exactly what happened. But, and rightly so, I mean, they failed to take action for a few years. They're going to pay the price.
What kind of advice would you give to somebody who just bought real estate in Vancouver?
Number one, keep all of the records, all of the advertisements, write down everything your realtor told you. Write it all down. Make sure that you have it on record. Because if the real estate agent made any indication at all that you were making a wise purchase, or you had to buy now because the market's only going to go up. Or the real estate agent did not warn you. You're going to be able to sue your real estate agent. I'm looking at my social media accounts. I have more lawyers from British Columbia that have started to follow me on the various media. I was shocked. You need to look at these people supposedly with these failed closings. Again, what you've watched is the realtors have used a concerted effort to create rumors, assumptions. They have not supplied one piece of hard data. It's been a month. Not one piece of hard data has been produced. What I'll tell everybody, any of your listeners here who knows someone who sold their house to a foreign buyer who is saying that they are not going to close. Your real estate agent obviously did not get a large enough deposit from that buyer. Your real estate agent obviously did not tell you when you're selling to an out-of-town buyer, you've got no one to sue. So don't go out and buy another house. You have to take some temporary accommodation to make sure your own closes before your new property is purchased. You have to go back and check every single piece of paper that those real estate agents gave you, because I can assure you, they did not counsel you to contact your lawyer and speak to your lawyer before you sold to a foreign buyer. Remember, our clients moved on this back in March.
Ross, thank you so much for being on This Week in Money. Is there any way somebody could contact you if they had more questions about this?
I would suggest every one of your listeners who owns a home anywhere in Canada goes to thewealthyhomeowner.ca. That's all I need to say.
Thank you again, Ross.
Thanks, Jim.
My guest has been real estate consultant Ross Kay. He was speaking to us from Burlington, Ontario. Coming up from Japan, James Corbett, the editor of the Corbett Report. Next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He's speaking to us from Japan, where he has worked and lived since 2004. The Nikkei stock exchange crash and housing bubble burst both took place in Japan 2.5 decades ago. Is Japan better off today than it was back in 1989?
Well, I guess it depends how you look at it. It's better off in the sense that we're not seeing a precipitous collapse right now, but it's certainly not that it's in a stronger position. In fact, just this past week we saw Japanese stocks tumbling again as the yen continues to rise against the dollar and threatens that 100 USD JPY barrier, which is pretty abysmal for a Bank of Japan that has been dedicated over the past couple of years to trying to keep the yen down with all of their might and all of their injections into the markets. They haven't been able to do that. But something they have been able to do, amazingly enough, a new Bloomberg analysis is showing that not only is the Bank of Japan currently one of the top five shareholders in 81 different companies on the Nikkei 225 index, they are about to become the number one shareholder in 55 of those firms by the end of next year. And of course, the BOJ doesn't directly hold shares of companies, but they do purchase ETFs. And their ETF buying spree doubled at the end of last month. Kuroda, the Bank of Japan governor, decided to double their ETF purchases. So things are getting more and more out of control, and it is increasingly an economy that is being propped up by the Bank of Japan.
How dangerous do people feel that is, or are they worried about it?
People are definitely worried, and in fact, that Bloomberg report quoted the senior strategist at Sumitomo Mitsui Asset Management, which manages, I think, a few $1 trillion worth of assets. Masahiro Ichikawa was quoted as saying, "Only in Japan does the central bank show its face in the stock market this much. Investors are asking whether this is really right." And I note, as a side remark, well, yeah, I suppose the Bank of Japan is quite openly buying ETFs and propping up the stock market, but that doesn't mean that the Fed and other central banks aren't, doing it through the back door. But I think the point is well taken. The BOJ is quite open about what it's doing, and investors are getting nervous about it.
Now, Japan just launched a new equity or incentive plan. What was it? Was it enough? And what was the reaction?
So they've just launched a new stimulus package. It's 28 trillion yen of stimulus, but I think that's about 276 billion US dollars. But that's a bit of a misleading number. Some of it is really just numbers that weren't accounted for in the general budget that they're sort of adding on to that. But about 10.7 trillion yen of it, so somewhere in the neighborhood of $100 billion, is being allotted for infrastructure projects specifically. That could actually have some sort of bonus to the economy. But the Japanese economy is increasingly relying on this type of stimulus, and either the buying sprees from the Bank of Japan or the stimulus package from the government to even achieve the kind of incredibly anemic growth that they are achieving right now. So again, none of this is particularly good news for the Japanese economy. It just means that there's another round of spiked punch to go around. But once that punch bowl runs out, I think the economy is going to definitely be feeling the hangover.
Isn't the Japanese government notorious for building bridges to nowhere and charging tolls that are so high nobody travels in these new tunnels and bridges?
I can attest to the fact that this is a country that is constantly under construction and not necessarily useful construction. You will have teams that go out at night to dig up a road and then pave it over in the morning and do that over and over and over and over again with seemingly zero difference for many months on end. And it's, I think, quite notorious that the construction industry here is really run by the mafia and by ex-police who get these golden parachutes into these construction positions, which win cushy contracts from the government to do make-work projects. It really is just a way to try to boost employment. And it is a boondoggle, but it is the way business is done here.
Why are politicians and the media promoting divisiveness? The Republicans versus Democrats, the 1% versus the 99%, black versus white. And what effect could this have on the American and world economies and our way of life?
I think this is one of the most notable parts of this whole election circus that's going on in the United States right now, is that it, less so than even the usual kind of left and right and Republican and Democrat divide, I think there's a much deeper division that's being driven certainly through the American population right now, and I think we can see this in other countries. And the question of why it is being done is one that is, by its nature, going to be somewhat speculative. But I think the fact that it is being done is pretty undeniable now. And I've noted in a recent report on my site, even the many mainstream outlets, including CNN and the New York Times, outright saying that they have to drop the pretense of journalistic objectivity and take sides in the election because Trump is just so crazy. Regardless of what you think of Trump or Clinton, I think the point is that type of outright bias and the backroom shenanigans of the Democratic National Convention and all of these things really just serves to amp up that cultural crisis, that divide, that seems to be part of a divide and conquer strategy. And I don't see any way of this resolving anytime in the next few months. I don't think it matters who wins the election. There's going to be a lot of deeply, deeply unhappy people, and the cycle of violence looks like it's only set to ramp up from here. It is strange to look at what's going on, and it is interesting to contemplate whether or not Trump is, in fact, trying to throw the election. But regardless, again, whether that is the case or not, I think it's quite easy to imagine, say, a possibility of Hillary winning the election and having tens of millions of deeply disaffected American voters deeply unhappy with that. And that can spill out into violence in the streets, as we're already seeing in places like Milwaukee and other places. I think that's one aspect of the phenomenon that's taking place right now.
Could we see the development of a viable third party in the U.S. because of this?
if we don't see it now, I imagine we never will. I think this is the prime opportunity for such a development. Interesting, of course, that the Libertarian Party is fielding a couple of candidates who are all over the place politically, and I'm not sure whether they would appeal to voters on the left or the right, or perhaps neither, with their sometimes contradictory policies. And Jill Stein is, with the Green Party, is probably not that much better positioned to siphon off any of the votes. So I think this is the precise time for a third party to actually arrive on the American political scene, but I don't actually see that developing this election cycle.
Freedom through technology. On one hand, technology has created more freedoms for people. On the other hand, it's facilitated governments becoming more Orwellian. I mean, they can read your personal email from a van parked across the street. Which one's winning right now, the Orwellians or the freedom people?
It's difficult to say. I think in terms of the general population, I think the Orwellian surveillance state is well in place, well entrenched. But there are a lot of different ways that people can act against that if they are motivated to learn about them and interested in them. So there are a lot of really innovative technologies that are coming through right now, not only with cryptocurrencies like Bitcoin and things of that nature, but the way that the blockchain technology that underlies Bitcoin is now being used to start all sorts of different types of projects, including Steemit and things like this that are coming along that are a decentralized blockchain-based social media platform that is not censorable in the way that a Facebook or a Twitter is. There really are some really amazing things that are happening, but you have to be dialed into that to even know that they exist. And you have to have at least an interest in finding out about them to be motivated to learn how these different technologies operate. And I think the vast majority of people aren't really interested in that. They just want to, boot up their Facebook and check their latest messages, and that's it. And for those people, I think they're going to be increasingly ensconced in a world that is increasingly surveilled. And one aspect of that we could look at is something like Saudi Arabia, where they are now asking for fingerprints in order to purchase a SIM card for your phone, because you need biometric details so that you can verify someone's identity so that they can get a phone so that you know that they're, if they're involved in any terrorist shenanigans, you'll know who they are. Well, that's the type of future that we're moving into. It's going to be increasingly surveilled and controlled, and I think that's something that people should be concerned about. And I think Orwell and even Huxley and people like that who were writing about these types of nightmare future societies just a couple of generations ago, I think we're starting to live through those societies, and it would behoove us to know what they were warning about and why it was so scary a concept to our grandparents and things that we just take for granted right now.
Yeah, and considering that Orwell wrote about these things in the 1940s, television had hardly been invented, let alone computers and cell phones.
And yet there's the telescreen, the two-way thing that's watching you both ways, and that's a pretty perfect metaphor for the Internet, which, of course, as we know, increasingly, our data is being scooped up and stored and is being analyzed and data mined through all sorts of government programs and agencies, including the NSA and other things that are happening in DARPA and the bowels of the Pentagon and other places besides. And either we can trust that the government is perfect angels to steward over this information and that we can trust them 100%, or we should be looking at the different types of disruptive technologies that are coming online to stop, if not stop that surveillance, at least undermine it in some way.
It seems like people are being subjected to more and more propaganda as well as hedonic numbers. Do stock and commodity markets factor this into their pricing?
You would think they would, but honestly, I think that the undeniable, overwhelming driving force in the stock markets today, certainly in the American markets, and I think in a lot of markets around the globe, is the central bank injections of liquidity. That has to be seen as the driving force behind the markets right now. There is no escaping that the vast majority of the rise in the S&P and the Dow Jones that we've seen since the 2008 Lehman crisis has been as a direct result of Federal Reserve injections. And I think, again, we see similar things taking place here in Japan. We see it in Europe with the European Central Bank. The central banks are driving the markets right now. So it's the old adage: you can try to bet against the Fed, but you can't win that bet forever. And the Fed can go longer than you can as an individual investor. So it is topsy-turvy. It is ridiculous in a lot of ways. It defies a lot of economic sense. We're seeing just stock indices that should not be happening right now. We see rises in stock markets that should not be happening. We just saw a record set on the Dow, S&P, and the Nasdaq all together for the first time since the tech bubble. That should be a warning that this is another bubble, that one that has been inflated by the central banks themselves. But I think investors aren't going to learn that lesson until the market starts to turn and they all get caught out on the losing side of that trade.
You're listening to This Week in Money. I'm Jim Goddard. We're chatting with James Corbett from Japan. He's the editor of the Corbett Report. The U.S. Fed still keeps making noises about hiking rates sometime this year, perhaps now as late as December, and yet the analysts I talk to think there's very, very little chance of that.
I can't possibly imagine how they could get away with, or even think they could get away with doing that this year. I think it's a pipe dream. I think they're just floating that to try to, as a way of trying to sound optimistic about the economy. But I really can't imagine that they're going to be able to do that unless something drastically changes in the economic outlook and drastically changes for the better between now and the end of the year. But it doesn't look like there's any particular reason for celebration on the horizon. And in fact, there are more indicators that the U.S. is in fact heading into recession, if not already there. Remember, recession is a 2-quarter lagging indicator, so we will never find out about it until 2 quarters later. And there are signs right now that the U.S. may actually already be in the next recession.
Right, and of course, we look at their job numbers. On 1 week, they'll say we gained 275,000 jobs. But when you dig into the kind of jobs, 90% of them were minimum wage jobs for people 55 and older trying to top up their pensions.
Yes, the unemployment figures are, I think, famously cooked in a lot of different ways, and the labor force participation rate is one that some people are pointing to as a particularly good indicator of where things are, being down around the 60% levels, levels that haven't been seen in decades, which I think is probably the best indicator of the fact that the 4-5%, whatever they're claiming right now, is highly manipulated. And I think you're right. I think the majority of jobs that we've seen created in the past several years as part of this recovery, quote unquote, from the 2008 crisis, have been temporary and part-time workers that really, of course, are not stable positions and are not providing large wage growth or earnings for the people who are involved in them.
Well, the TV show Undercover Boss, which is filmed in both Canada and the U.S., I am so amazed at how many of the workers profiled on those shows hold 2 or 3 part-time jobs and are still struggling to feed their families, so that very kind boss who actually got to work alongside them will give them a bonus or send their kid to college or something. But what about the other 10 or 15,000 people working for that company?
It's exactly right, and I think this is one of the symptoms of our times, and something that's been talked about. And I think this is part of what's feeding into that divide and conquer, that rage that we've seen and that we've just discussed. I think that a large part of this has to do with the economic fundamentals. And in a time when everything's booming and everyone's employed, you see a lot less social unrest and strife. But when things are falling apart economically, you start to see that rising. And I think that's yet another indicator that whatever quote-unquote recovery we've experienced during the last several years has been largely ephemeral, and largely the benefits of that have gone to the upper echelons of the pyramid rather than the lower echelons.
Has the trickle-down theory ever worked?
That's one for the macroeconomists. I'll let them duke that one out. But I think that the underlying point of this is that we're transitioning into a different type of economy right now, and I think that has largely taken place precisely because of Fed liquidity injections into these banks that should have failed 7 years ago. There should have been a massive default of a lot of these banks and a consolidation in the banking industry, and a break to the crazy practices that were going on in the casino economy of the early part of last decade that led to that crisis. We never saw that correction. We never saw the contraction. And as a result, we're even more precipitously perched on the edge of catastrophe than we were several years ago, because instead of deflating that bubble, they've just blown it even further.
Former President Bill Clinton has said his biggest regret about being president was removing the Glass-Steagall Act that forbade commercial banks that deal with consumers from getting into the speculation market, and yet they're still there and nothing's been done about it.
That is true, and Glass-Steagall is an interesting part of all of this, but I think we should look at the other side of this, that there have been people arguing that there is not a single part of the 2008 crisis that can be actually put on Glass-Steagall, and the removal of that in the 1990s under Larry Summers as Treasury Secretary. And I will direct your listeners to the Tom Woods podcast, which actually had an interesting episode about this, pointing out the actual changes that were made and how they did not have any effect on that bubble, the housing bubble itself, and what ultimately ended up happening in 2008.
Just before we went on air, I saw a headline: the Chinese government has uncovered a $30 billion illegal banking industry. I think you talked to me several months ago about how in China, because it was hard to get interest or loans at a variable rate that was decent, people were going underground something fierce and paying very, very high rates. Is this really what's been uncovered?
I haven't seen that particular headline, so I don't know if that's what that story is talking about. But yes, there certainly is a shadow banking industry in China that is out of control, and it is certainly to the tunes of tens of billions, if not more, because people are looking for those types of returns on investment that are offered by pretty shady schemes that really are Ponzi schemes at the base. They really do require new people buying into them in order to pay off the people who are already invested. And there's already been a couple of times in the last few years where the Chinese government has had to step in directly to stop some of these from defaulting. I think that's a sign of where China is in terms of overall in its economy. And in fact, take it for what it's worth, but we just had Soros coming out and saying that he sees an eerie resemblance between what's happening in China right now and what happened in the financial crisis of 2007-2008. He says, quote, "It's similarly fueled by credit growth and an eventually unsustainable expansion of credit." And I think part of that unsustainable expansion of credit is this shadow banking industry that's really arisen in the last several years in China as part of the sort of opening of the floodgates from the Chinese central bank, making this liquidity quite available, this credit quite available. So I think that is definitely being seen right now. I don't know if China is moving to crack down on that, but they have tried to close that spigot before in the last few years, and every time they do, there's a huge cash crunch and a crisis, and they have to ultimately open that spigot back up. So we'll see if they're able to clamp down on it, but it seems unlikely given the types of huge growth rates that they're looking at and that they want to maintain. That can only be maintained by expanding the credit bubble.
Well, China officially only allows you to take out $50,000 a year from the country, and yet a so-called Chinese student was able to purchase a property in Vancouver for $31 million. That's a little more than 50 grand.
Oh, there are always ways around these types of rules and regulations, especially for connected people and people with that kind of money to throw around. And there are a lot of different ways to do it. And I think this is one of the sort of most well-known conduit for money that's fleeing China right now and fearing a potential devaluation of the yuan, which could come at any time. And I think in order to stave that off, we see a lot of newly rich who are really trying to get their money out of China in any way possible. And I think the conduit that's presented itself for the last several years has been property, especially real estate in the Vancouver area. So, and as we've talked about before, the BC is trying to crack down on this right now, but it's certainly questionable whether that's going to have the intended effect or whether that's just going to be a little bit of cash skimmed off the top for tax purposes, while the people who are willing to pay tens of millions of dollars for property they're never going to set foot on will continue to do so, even if it means an increased tax rate.
Any chatter in Asia right now or Japan about the 15% foreign buyer tax that the BC government imposed at the start of August on foreign buyers looking at real estate in Greater Vancouver?
These are people who are desperate to get their money out of the Chinese system, and if they have to take a further 15% hit, I'm sure a lot of them would be willing to do so. We'll see. I mean, this will play out in the next several months, and we'll see if this does have an effect on calming the markets. And I'm sure it will have some effect, but I'm not convinced that it's going to be as much as maybe the government is hoping.
China's premier has approved a connection between the Shanghai and Hong Kong stock exchanges. Does that open Hong Kong to more abuse and manipulation?
It potentially, it certainly does. Maybe it opens Hong Kong up to more abuse and manipulation. I guess that goes both ways. But we'll have to see what the stock link is really going to do. But it certainly could. We definitely know that a lot of games get played on these types of exchanges in order to benefit from arbitrage and capital flows. So we'll see. We'll see what effect this ultimately ends up having.
Goldman Sachs is warning its customers to be very careful when they look at China's economic recovery numbers. Should they be?
China's economic recovery numbers? Well, yes, I think so. Again, as we discussed, I think what Soros is pointing to is really the case. That this really is a time where we see these types of growth rates that China is aiming at, which are completely and utterly unsustainable in any other way but credit expansion. And given the amount of credit expansion in the Chinese economy over the last several years, well, like all good bubbles must come to an end. And in fact, even the IMF are now talking about this, talking about unsustainably high growth targets, talking about a hard landing for the Chinese economy. So I think this upcoming G20 that's going to be taking place in China in September is going to be extremely interesting. There's obviously going to be a lot of talk about the Chinese economy at that time and how it fits into this new global game that's being played with the central banks. And of course, in preparation for the October listing of the yuan in the basket of currencies that the IMF uses to determine the weight of its SDR, special drawing rights. So there's some interesting moves afoot, and I think they're going to be concentrating on China in the coming month or two.
A Malaysian diesel tanker was hijacked, apparently a very high-valued target. How often does that happen in the Asian waters?
I wouldn't have the numbers on that. I don't know specifically, but I don't believe that to be a common thing. I certainly don't hear about it very much, but again, that could be a reflection of media reporting on the issue. But it is certainly interesting, of course, because we are looking at waters that are increasingly under tension, of course, with certainly the South China Sea coming more and more under the purview of China and the Chinese claim to the so-called 9-dash line, where they're claiming huge portions of that water for their own purposes. So we're going to see a lot more disputes over that. Whether or not how that will play into hijackings and things of that nature, we'll have to see. But I certainly haven't heard of a lot of that going on in those waters.
And of course, that could give China even more reason to put its Navy in those waters, saying we're just there to protect everybody.
Or the other way around. It could be Malaysia or the Philippines or others calling on the U.S. We need more patrols of these waters, which again could feed into that. So I think it could go both ways. But either way, I think more militarization of those waters would seemingly be the inevitable conclusion.
James, it's been great having you on the show. Thanks for joining me on This Week in Money.
Thank you for having me on. I appreciate it.
My guest has been James Corbett, publisher of thecorbettreport.com and editorial writer for the International Forecaster. He was speaking to us from Japan. Coming up, Mackey Research investment advisor Payton Nyquvest on This Week in Money.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Payton Nyquvest, Vancouver investment advisor at MackeyResearch.com. Welcome to This Week in Money, Payton.
Thanks for having me.
How did the junior markets do in Canada this week?
The venture market was kind of flat for the week here. It opened up at 8:40 and closed at about 8:34, 8:35. So fairly flat for the week.
Now, the Venture Exchange has seen some pretty good action over the last few weeks, though.
Absolutely. It's been the busiest August that I can remember in quite a long time. So,
what's driving the action?
The gold stuff has seen a lot of activity in the last little bit. Uranium stuff has picked up. The sentiment in the resources seems to be improved greatly here in the last, I'd say, 6 months or so.
When the Sprott Asset House held its conference, it was packed, it was sold out, and they hadn't seen that kind of excitement about mining in Canada for 5 years.
Yeah, it's been a very nice change. It's been 5 years, as you said. We're well overdue here now. So the gold price is obviously a big component of that, and the gold price has rallied quite a bit here in the last pretty much since January.
What's happening with silver?
You know, silver kind of usually lags gold by a little bit, but starting to pick up as well and get some attention. But gold's definitely been the focus for the last little bit.
Diamonds, the hidden Canadian asset that we don't think of ourselves as a diamond-producing country, but we sure are.
Yeah, you know, the diamond industry, especially in Canada, started to get really interesting. There was some excitement, obviously, around Lucas Lundin's Lucara when they were pulling some very large stones out of there, and now Stornoway, which is operating in Canada, is set to go into production this month and has come out saying that they're going to pay a 45-cent dividend. And Mountain Province, which is up in the Northwest Territories, is set to go into production here next month as well. So should be a lot of attention coming out of there, and you're seeing that start to trickle down to the juniors. Actually, Canalaska, which is operating in northern Saskatchewan, just announced that De Beers is going to be going out there and drilling their property. So lots of activity going on in the diamond space as well.
Yes, and Canada's diamonds are different than South Africa's. Ours are easy to get because they're on the surface.
Well, that's kind of been the sentiment, and for the last little bit, most of the drilling's done within 150 meters historically around Canada, and typically are very gem quality diamonds, especially up in the north.
Well, I was going to say Canadian diamonds so valued, there's now fakes with little polar bears etched into them with lasers.
Yeah, you're seeing, you know, listening to the radio the other day, the typical Spence diamond commercial, they're manufacturing diamonds now, so there's no shortage of people looking for the Canadian stamp.
What's happening in the uranium field?
Uranium's gotten interesting in the last little bit. You know, spot price is still below 30, but you're seeing companies like UEC, which is they've climbed from kind of 70 cents to over $1, and you're seeing a lot of activity in that northern Saskatchewan region, which got a lot of attention a couple of years ago. The next gen discovery has obviously been kind of the focus around that, as well as fission, and even down to some of the juniors like Sky Harbor, who's just brought on Denison as a partner and has started to do a lot of work up in that area as well.
Is there much action on the new Canadian biotechs?
The biotech stuff has been, you know, it was busy while the resource market was slow. It's quieted off a little bit, but I think there's still some attention there, probably spillover from the U.S., which is still quite active in the biotech sector.
Is the new marijuana business part of the new sector?
You know, I think a lot of people are still waiting to see where the chips are going to fall with the marijuana business in terms of government legislation. It's a bit of a moving target, but you're seeing a lot of the medical marijuana companies start to gain a lot of traction here in the last little bit as well. There's actually a couple new ones that are starting to come to market here in the next probably 6 months as well. So,
Are those companies kind of a mix of both private and public placement?
You know, there was a lot. It was obviously tricky to get marijuana companies listed on the exchange. There was a lot of people that were able to do it, but it's a new industry, so there's a lot of hurdles that you've got to jump with that. So I think some of the companies that have decided to stay private are probably waiting until they can grow to a certain critical mass before trying to take the public route.
Payton, before we go, maybe tell our new listeners a little bit about Mackey Research.
Sure. Mackey Research is one of Canada's largest independently owned investment firms, specializing in wealth management as well as wealth creation, whose focus has been providing clients with access to unique products as well as having exceptional personalized service.
Payton, thank you so much for chatting with us here on This Week in Money.
Thanks for having me.
My guest has been Payton Nyquvest, Vancouver investment advisor at MackeyResearch.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ross Kay, James Corbett, Payton Nyquvest, and thank you for listening. Questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.